Rome collapsed, the Ottoman Empire dissolved, the Soviet Union disappeared in a matter of months. Entire political systems gone, but certain assets, they didn't just survive, they transferred, they adapted, they kept compounding under new flags. Here's the uncomfortable question: if your wealth only works in one version of the world, is it actually wealth? Today I'm going to walk you through 10 assets that outlived empires. Some of them you expect, a couple of them you probably don't. And the last one, almost nobody thinks of it as an asset, but historically it may be the most powerful one on this list. So stay with me, because by the end of this video you may realize you've been optimizing for growth instead of survival. My name is Grant, and on this channel we break down money, power, and long-term strategy. If you're someone who works hard, invests consistently, maybe even follows all the right financial advice, but still wonders whether your plan would survive a serious shock, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because here's what most people don't realize. Building wealth and building durable wealth are two very different games. One works in bull markets, the other works across generations. Today we're talking about the second one. Let's start with the obvious, and then we'll move into the assets that quietly shaped history behind the scenes. Number 1. Gold. Look, I know. Every time someone mentions gold, half the audience rolls their eyes. Okay, here comes the apocalypse guy. But pause for a second. Gold has been used as a store of value for over 5,000 years. Ancient Egyptians used it. The Roman Empire minted it. Medieval Europe hoarded it. Even after the US left the gold standard in 1971, central banks still hold it. Gold recently pushed above $5,000 per ounce. Not during a global financial collapse, not during hyperinflation. During a so-called stable period. And this is where it gets interesting. In 2022 and 2023, central banks bought over 1,000 metric tons of gold per year, the highest levels in modern recorded history. Countries like China, India, Turkey, and others have been adding aggressively to reserves. Let that sink in. The biggest institutions on Earth, with access to every economist, intelligence report, and monetary model imaginable, are hoarding the one asset that does nothing. That's not some YouTube conspiracy. That's balance sheet behavior. Now here's what most people don't realize. Gold doesn't generate cash flow. It doesn't grow earnings. It doesn't innovate. It just sits there. And that's exactly why governments like it. Because gold isn't dependent on another country's currency. It's not a promise. It's not a liability. It's final settlement. When trust in paper systems even slightly cracks, gold becomes political insurance. And suddenly, the apocalypse guy doesn't look so crazy, at least not to the world's central banks. This isn't about panic, it's about noticing what the most powerful financial institutions are quietly doing, not what they're publicly saying. Number 2. Productive land. Empires rise and fall. People still need to eat. The Roman Empire collapsed in 476 AD, but farmland in Italy? Still producing wheat today. After the fall of the Soviet Union in 1991, political systems changed overnight. But farmland in Russia didn't vanish. Agricultural land has survived feudal systems, monarchies, dictatorships, and democracies. In the US, farmland has returned roughly 8 to 12% annually over long periods depending on the time frame, through wars, depressions, and political chaos. And here's the math. If land appreciates at just 5% annually, $100,000 becomes over $265,000 in 20 years. But unlike many assets, farmland also produces income while it appreciates. This is where it gets really interesting. When paper systems collapse, productive assets that create food become even more valuable. Because demand doesn't disappear. Psychologically, land taps into something deeper, survival. You can't print food, you can't code wheat. Productive land outlived Caesar. It outlived the czars. It outlived the British Empire. And it will outlive modern governments too. Number 3. Businesses that solve basics. Empires change, tooth decay does not. Food consumption does not, healthcare demand does not. Look at companies that have survived wars and collapses. Nestle was founded in 1866, Johnson & Johnson in 1886, Coca-Cola in 1892. They survived 2 world wars, the Great Depression, multiple recessions. Why? Because they solved non-optional problems. According to Bureau of Labor Statistics data, healthcare spending in the U.S. has increased almost every single year for decades, regardless of economic conditions. Here's what most people don't realize. The most resilient businesses are boring. They don't depend on trends, they depend on biology, and biology doesn't go bankrupt. Number 4. Infrastructure. Roads, bridges, ports, energy grids. The Roman roads still exist in parts of Europe, over 2,000 years later. Infrastructure is civilization's skeleton. During the Industrial Revolution, railroads became the backbone of economic growth. Even after financial panics wiped out investors, the tracks remained. Here's the math. If a toll bridge processes 100,000 cars per day at $5 per vehicle, that's $500,000 daily revenue. That's $182 million per year from one physical asset. Infrastructure survives political cycles because it's too important to disappear. Ownership shifts, utility remains. Number 5. Real estate in prime locations. Rome fell, but property in central Rome, still valuable. Location-based real estate, near trade routes, ports, major cities, tends to survive political shifts because geography doesn't move. London real estate survived wars, bombings, economic crises. Prime New York City property has compounded through recessions, inflation, and global turmoil. Here's what most people get wrong. They think exposure to prime real estate means buying a $3 million brownstone in Manhattan. It doesn't. You don't have to own the whole building to participate in the economics of the location. There are structures, like publicly traded real estate investment trusts, that allow people to own fractional exposure to commercial buildings, apartments, logistics centers, without being a landlord fixing toilets at 2 a.m. This isn't about flipping houses, and it's definitely not a recommendation to run out and buy anything. It's about understanding the principle. When humans concentrate in specific geographic hubs, financial centers, logistics corridors, innovation clusters, economic activity compounds there. And where economic activity compounds, capital tends to follow. Empires change, but ports, crossroads, financial centers, they keep attracting gravity. Number 6, intellectual property. Books outlive governments. Religious texts have survived thousands of years. The works of William Shakespeare survived monarchy, changes, revolutions, and world wars. Ideas travel. Borders don't stop them. But here's what most people miss. You don't need to be a genius inventor to benefit from intellectual property. Today, IP shows up in things like patented drugs, software platforms, global brands, music catalogs, film libraries, and a lot of those are owned by publicly traded companies. When you own shares of businesses built on patents, copyrights, or brand power, you're indirectly owning intellectual property that generates recurring income, subscriptions, licensing fees, royalties. And here's why that matters. A factory can be bombed. A building can be seized. But code, a brand, a global catalog of content, those can move. They can be licensed. They can operate across multiple jurisdictions. This isn't about telling you to go write the next bestseller. It's about recognizing that in the modern economy, some of the most durable cash flows come from assets you can't physically touch. And that ownership exposure doesn't require you to invent them yourself. Ideas scale, and scalable assets tend to outlive political systems. Number 7, human capital. Now here's the one nobody expects on this list. You, human capital. After every empire collapsed, the most valuable people weren't the richest, they were the most adaptable. After World War II, millions rebuilt Europe and Japan from rubble. In post-Soviet economies, entrepreneurs created entirely new markets from scratch. And look at today. Countries are competing aggressively for skilled immigrants, engineers, doctors, software developers, tradespeople. Why? If land and gold are so important, why are governments offering fast-track visas to programmers and surgeons? Here's the answer. Because human capital creates everything else. Skills generate productivity. Productivity generates tax revenue. Tax revenue funds the state. That's why advanced economies design visa programs specifically to attract high-skilled workers. They're not doing it out of charity. They're importing economic engines. Here's what most people don't realize. Your skills are portable across regimes. Land can be seized, gold can be confiscated, stocks can crash. But knowledge travels with you. If you increase your earning power by just $10,000 per year through skill upgrades, and invest that at 7% annually, over 25 years, that alone becomes over $630,000 in additional capital. That's not from picking stocks. That's from becoming more valuable to the marketplace. Skills compound, empires collapse, competence travels. Number 8. Diversified global exposure. Empires collapse locally. Global diversification spreads risk. And this isn't theoretical. It's happened recently. Take Japan. In 1989, Japan's stock market was nearly 45% of the global index. Then the bubble burst. The Nikkei fell almost 80% over the next decade. For over 30 years, Japanese stocks never returned to their 1989 peak in nominal terms. If you were a Japanese investor fully concentrated at home, you lost decades. But if you owned global funds, including US and European companies, your capital continued compounding while Japan stagnated. During the 1970s, the United Kingdom faced high inflation, currency weakness, and economic stagnation. Investors concentrated only in UK assets struggled, but exposure to US and other international markets reduced the damage significantly. More recently, Russia in 2022. When markets were halted and foreign listings suspended, domestic investors were locked in. Russian equities effectively became untradeable for long periods. But global investors who had broad international exposure, they felt volatility, but not total immobilization. Here's the key point. None of this required being a billionaire. By the late 20th century, mutual funds and later index funds made international diversification accessible to ordinary middle-class investors, teachers, engineers, small business owners. This wasn't elite capital flight. It was basic asset allocation. Here's the psychological trap: home bias. We assume our country is safer because it's familiar, but familiarity is emotional comfort, not risk management. Resilience doesn't mean betting against your country. It means not betting exclusively on it. Number 9. Energy assets. Coal-fueled empires. Oil reshaped the 20th century. Electric grids persist through government changes. Energy demand doesn't vanish. Even during recessions, consumption dips temporarily, then rebounds. Homes still need heating. Data centers still run. Hospitals don't shut off power because GDP slows. But here's where this becomes practical. You don't need to own an oil field or a nuclear plant to have exposure to energy infrastructure. Publicly traded companies operate pipelines, transmission grids, LNG terminals, renewable installations, utilities. Some of them generate revenue based on long-term contracts, not daily oil prices. That's a key difference. There's speculation on energy prices, and then there's ownership of the infrastructure that moves or produces energy. If a pipeline transports gas under 10 to 20-year agreements, Its cash flow model looks very different from a trader betting on crude prices. Again, this is not telling you to buy anything. It's about recognizing the structure. If you have exposure to businesses that operate the fuel lines of civilization, electricity transmission, power generation, distribution networks, you're tied to something societies prioritize regardless of who's in office. Governments change, policies shift, but turning the lights off? That's not optional. Energy demand persists. Number 10. Time. This one sounds abstract, but it's arguably the most powerful asset of all. The people who survived empire collapses and rebuilt wealth had one thing in common. They didn't panic into permanent decisions. They preserved optionality. Time compounds capital, but it also compounds wisdom. If you avoid catastrophic losses, even modest growth rates create massive outcomes over decades. $100,000 at 7% for 30 years becomes over $760,000. That's not sexy, but it's durable, and durability wins across history. Here's what most people don't realize. They build portfolios for smooth decades. History doesn't move in smooth decades, it moves in shocks. We optimize for maximum return during stable periods, bull markets, low inflation, predictable policy. But the assets that outlived empires weren't the flashiest. They were the most structurally durable. Monetary insurance, like gold when confidence cracks. Prime geography, even if accessed indirectly. Intellectual property that scales across borders. Energy infrastructure civilization can't function without your own portable earning power. Global diversification beyond one political system. The mistake isn't chasing growth. The mistake is concentrating fragility. Home bias. Over-leverage. Overconfidence in this time is different. Believing your country, your currency, your system is immune to history. Every empire thought that. Every single one. So why do smart people still get this wrong?
Because stability feels permanent when you're living inside it. That's called normalcy bias. We assume tomorrow will look like yesterday because it usually does, until it doesn't. And here's the deeper layer. Most people invest based on recent performance, not structural resilience. If US markets have outperformed for 15 years, we overweight them. If real estate has boomed locally, we assume it always will. If energy is unpopular politically, we assume it's obsolete. But civilizations don't run on headlines. They run on incentives and necessities. Food, energy, housing, productivity, ideas, human skill. Those forces outlive administrations. So what do you actually do with this? Not panic, not hoard canned food, not liquidate everything into gold. That's reaction. What we're talking about is design. Think in layers. Layer 1, personal resilience. Increase your earning power. Upgrade skills annually. Stay employable globally. Layer 2, structural exposure. Have some exposure to assets tied to human necessities, energy, infrastructure, prime geography, intellectual property. Layer 3, geographic balance. Avoid concentrating everything in one country, one currency, one regulatory system. Layer 4, avoid fragility. Excessive debt is what destroys people during transitions, not lack of opportunity. Notice something. None of this requires predicting the next collapse. It requires acknowledging that history cycles and positioning yourself so you're not wiped out if it does. Rome looked permanent. The Ottoman Empire looked permanent. The Soviet Union looked permanent until 1991. Here's the thing. The goal isn't to guess which empire falls next. The goal is to own assets and build capabilities that continue working regardless of who's in charge. Because wealth that only functions in one political climate isn't wealth, it's conditional privilege. And conditional systems eventually change. If this shifted your perspective, even slightly, hit the subscribe button and give this video a thumbs up. Because we're not trying to chase trends here, we're trying to build resilience, assets that outlive empires, and a life that doesn't depend on one version of the world staying comfortable forever.